Hi everybody, this is Mike from Better Being, and I'm really glad to be back with you today because I want to talk about something else, another subject that's pretty near and dear to me, and that is credit versus cash. Okay, now a lot of people are afraid of credit because they think that credit can actually ruin your credit score if you use it improperly, and that's true, but you have to be able to use credit the right way, because if you use credit the right way, it could really build up your credit. Building up your credit helps you get things like loans, and if you own businesses, it helps you get things like collateral and cash. And then there's using cash. So there are benefits to using cash as well. And so I want to kind of go over a couple of different points today, and then you guys can discern for yourselves what's right for you, using credit or using cash. And so when we talk about credit, we remember credit, there's two types of credit. So there's revolving credit and there's non-revolving credit. So with revolving credit, you don't have to pay off that balance at the end of every month. You could pay off a certain amount, which is usually a minimum payment, or you could choose to pay off the entire payment. Keep in mind that if you don't pay the entire amount off with revolving credit, there are interest penalties, okay? Now with the non-revolving cards, you need to pay off the interest at the end of every month, or they will impose penalties on you for that as well, and also revoke some or all of your credit. So you have to be careful of that. But if we talk about credit, we're talking about interest and fees. So with credit cards, you have interest and fees. You have a revolving credit card, and if you don't pay off the full balance of that credit card, you're going to pay interest on the amount of money that you are borrowing from the credit card company. And so there are also fees involved, right? So if you, for whatever reason, you don't pay your credit card on time, you're going to get a late fee for not paying your credit card on time. If you go over your limit, for example, the credit card company may allow you to go over your limit, but there might be a fee associated with going over your limit. So there are fees and there are costs to using the credit card. Some credit cards even charge you an annual fee to use their card. Now, the ones that charge you an annual fee, they normally have a lot of perks with them, a lot of rewards and things like that. So usually if you use your credit card enough, those fees to use that credit card will or the benefits of that credit card that you get back, the perks, will far outweigh the fees that you pay on that credit card. The next thing is the perks. So normally perks happen for cards that you pay for, but you can also get perks for cards that you don't pay for. Things like that include like cash back, for example, travel protection, all different types of things that you might have on the credit card. So that's a really good reason to carry a credit card in your wallet, to have those different perks available to you. Protection. So for example, if you go into a transaction with somebody, say on PayPal, for example, and I mean, long ago, PayPal didn't have, different restrictions and policies in place for people that didn't fulfill the orders. But if you did go into a transaction with somebody and for whatever reason they didn't fulfill the order, or if you bought something on Amazon and you got overcharged, you got charged for 2 items instead of 1, if you call your credit card, more often than not, depending on the credit card company, they will remove the charge that was placed on your card accidentally, right? Spending power. So with credit cards, you have spending power. With cash, it's a little bit more finite. The credit cards, it's finite also, meaning there's not an infinite amount of money on your credit card, but with a credit card, there is usually a lot more flexibility for spending power. Now, with that spending power, there also comes responsibility to understand what your budget is, understand how much you bring in every single month, and how much goes out of your household every single month, so that you know that you have enough to pay off your credit card every single month. And the goal, from my perspective, is when you're using a credit card, always make sure that you pay that balance off every single month. Because if you don't, you're going to pay an interest or a penalty on the amount that you are using, on the amount that you are technically financing from the credit card company. So this is where credit cards become really interesting, because they can become a really good tool, because you don't have to carry cash, you don't have to risk that the cash might be stolen, there might be a theft. You can actually carry a credit card, you have that protection for your money that you are borrowing from the credit card company. But just remember, if you get into a downward spiral where you are spending more than you actually earn and you're not paying that money back, then you are going to potentially get into a problem where it's going to be even harder to pay that credit card company back. They're going to start charging you more in interest, what can sometimes exceed 25, 28. I've seen rates as high as 30% on credit cards, depending on what kind they are. So you want to be really careful of that. And then it builds credit. So if you use your credit cards properly, it's going to increase your credit score. So if it increases your credit score, you can go to buy things like a vehicle or a home or something like that that requires credit if you're unable to pay cash. The dealers, the ones that are loaning you the money for whatever you're trying to buy, whether it be a vehicle or a home, they're going to look at your overall credit score. If your credit score is poor, there is a less of a chance that you would get that particular loan for a property or a vehicle, something like that, a large purchase. But if your credit score is good, then you stand a better chance of receiving that money, receiving that loan. So owning credit cards can increase your credit score, but you have to remember, pay off the credit card every single month, be on time, don't be late because you'll be charged a penalty for that. And that actually goes against your credit score. So late payments actually go against your credit score. The amount of credit that you have open, the amount of credit cards that you have open on your credit report, that goes against your credit score. The amount of payments missed goes against your credit score. The balances you have on your credit cards opposed to the amount of credit you actually have, that goes against your credit score. If you have a very high balance, if you have a very high, what they call debt to equity ratio with your credit cards as opposed to your debt. So the next thing I want to talk about is cash. So when we have cash, we risk theft of our cash. So if we're leaving our cash, say at the gym or something like that, we leave our cash in our wallet, we go work out, we come back, our locker's broken into, somebody's stolen cash from us, right? It could be a couple dollars, a couple $100, a couple $1,000, depending on what you carry. With a credit card though, if they steal your credit card, you can simply call up the credit card company and say, hey, listen guys, we got to cancel the credit card, somebody's stolen, no problem. They take care of it, they cancel the credit card for you. Any unlawful charges, normally credit cards companies will reverse those charges for you, really no questions asked, but depending on the kind of credit card company, I really like American Express. It has pros and cons, but when it comes to this service, I really like American Express for this service. I'm in no way endorsed by them, I just like what they do. The overdrafts. So if you spend more than you have in your bank account and you allow for overdrafts to occur, the bank is going to charge you for those overdrafts. And those overdrafts can sometimes be costly. I've seen anywhere between $15 to $35 to $40 per overdraft charge. And if you keep getting the overdrafts, then the bank will, of course, probably close your account, depending on what the situation is, but that's probably worst case scenario. With credit cards, there are no overdrafts. You have usually a larger amount to spend, but again, you want to make sure that you are gauging that with how much you're actually making during the month and how much you're going out, how much is going out at the end of the month as well through all your expenses. You want to know how much your income is, how much your expenses is, and make sure you're not spending too much. And then finite spending. So with cash, your cash is your cash. It's how much you have. So if you have $5,000 to spend and you haven't worked anymore and you're not going to get any more hours, or you're not going to work anymore to gain more cash or sell anything to gain more cash, your cash is what you have. It's $5,000. So that's what you have to spend. With a credit card, like I said, you have a little bit more spending power because normally credit cards have higher limits, higher balance limits, but again, you want to make sure that you're paying down those in a timely manner. And then less flexibility. So with your debit card, it's linked to your bank account. So there's a lot less flexibility there as opposed to a credit card that has different services to be able to give you benefits, perks, protect you against certain transactions that occur in your account. So it's a lot more rigid. It's basically, here, this card is connected to my bank, I'm going to give it to you, I'm going to pay you for the services, you're going to give me the goods or services that you promised, and that's really the end of the transaction. But with a credit card, if something happens, you have a little bit more flexibility there to be able to troubleshoot anything that happens as a result of maybe a bad transaction. And then no credit impact. So with cash, you really don't have any credit impact. Now that could be good and bad. If your credit history is poor, then you want to work to be able to build that credit history up. You want to work to be able to build that credit history up. And so gaining additional credit is not a bad thing, but you want to make sure that you're in a position to do that, okay? Now, if you are a person with credit, you also want to make sure that you are not opening too many cards, right? You don't have too many high balances on those credit cards as opposed to what your actual limits are. So there is an impact to having no credit. If you're using cash only, if you go to buy a home, if you go to buy a car and you're not paying those in cash, chances are you may not get the loan because you don't have the proper amount of credit needed to secure that loan, needed for the lender to be able to say, okay, we trust this person because of his credit score and we're going to go ahead, or her credit score, and we're going to go lend to him or her based on that credit score. So that's another reason why it's a really good idea to have a good mix of cash and credit. But the big thing again that I want to stress here is the fiscal responsibility to you. You need to be responsible for what you are spending on your credit cards. Now for me at one point, I was using credit all the time and I was just paying out the balances at the end of every month. And that's a really good thing to do if you have the willpower, if you have the habits, if you have the routines, if you have that responsibility where you're making sure that you're not overspending and you're paying off the balances every single month. You can get a ton of rewards from these credit card companies. You'd have to do a little bit of research to see which cards give the best reward, but you're gonna get a ton of rewards, you're gonna get a ton of perks, you're gonna get a ton of protection for using credit, and you're gonna build up your credit score. And sooner or later, if you're part of the younger generation, you're gonna wanna buy a house, you're gonna wanna buy a nice car, you're gonna wanna finance college for children, all that kind of stuff. That can all be done on credit using your credit score, but if you don't establish your credit early and be responsible early, that could be a problem later on. So guys, I hope this helps. I hope this adds value. If you guys have any questions, please comment on the bottom, like the channel, subscribe to the channel, and until then, I'll see you in the next video.